nuked again. So it tells you there's an extraneous factor. There's not enough liquidity around, which doesn't help. So crypto gets hit. And then there's this overhang thing. And I just think of it as like, we won't remember this in 6 months' time. No. And I just think that 2026, probabilistically speaking, has to be a good year because of liquidity, fiscal stimulus, and all the other stuff that's coming, regulation changes, and a Treasury Secretary who really understands about the business cycle and how we need to jam it if you want to win the midterm elections. I mean, it's all there, and they're telling it openly. From the work that we do, every Bitcoin dominance is driven by the business cycle. So if the business cycle is lackluster or early stage, then Bitcoin dominance tends to be higher. When the business cycle picks up, which it has not done because of liquidity and rates and stuff like that, then Bitcoin dominance remains strong. But the moment it changes, then everything starts to outperform. And Scott Bessent is telling you day in, day out, it's going to be a strong economy. And this is why all the forward-looking indicators suggest all of that. So the other thing is to bear in mind, and this only dawned on me the other day. I can't remember if I saw something on Twitter that made me think about it, but anybody who's bought Bitcoin is watching the announcements coming out of Wall Street and the government. And what they haven't figured out is that is all smart contract land. And they're in pristine collateral land. Two different things.
Yeah, totally.
Right, debasement, pristine collateral, the beauty of Bitcoin. We all understand that. But the actual action is about to happen in smart contract land. And people are wildly underweight that. Again, I was around the Middle East. They've all got Bitcoin, bit of it, not enough. They're all trying to figure out how to fit it in their portfolios. It's being top-down driven, like you need to have higher weightings in this stuff. The individual portfolio managers are like, we can't quite fit this in yet. Anyway, so they're getting there. But none of them own smart contracts.
Tokenizing every asset, and that's every security on the planet. So
if we step back and say, okay, well, why does this affect the underlying token prices? Because these are just slots on the blockchain that are going to be in demand. So every time you tokenize an equity, you're creating block space demand, which drives the value of the token network. So again, people don't really understand this stuff. There's been a lot of shit fighting about how to value networks because we've not seen a use case of this magnitude coming, but it vastly changes everything. They will try it, but they'll realize decentralization is where the security of the chain lies. And if the information they're transacting on that network is valuable, they need to have a decentralized chain. So my guess is they'll come round to it. But yes, there will be some private chains, much like there's still private intranets. But it's a player versus everything world. You and I have talked about this endlessly. People think of it as a PVP. The more use of blockchain, the more valuable all of our tokens become because the more use of blockchain. And the more people move around, the more applications get built. Because after the financial system, we haven't even got to tokenizing the internet. We got all the, the dreams of Web3. We only started that game. We're getting excited about the financial markets. The other side is addressable TAMs of 8 billion people. Yeah. And all of that will come. Will definitely come. It's like, every ticket, every contract ends up being an NFT. People don't realize the scale of this technology, but we don't have enough capital and we don't have enough attention to do it all in one go. And we didn't have the right regulation. So the regulatory green light goes to the people with the most instant capital, which is the financial system, because they capture the economic efficiencies of using blockchains super fast. So it makes sense to me. Eventually, the Web 2, the existing internet, will move to these rails. And so if you think about it in terms of time horizon, I keep saying you just extrapolate out the log trend of the market cap of crypto. We're at 3 trillion today. If you extrapolate it out into this nice little log regression like we all do on the Bitcoin chart, you get to about 100 trillion in 10 years' time or less by 2032, 2034. So if we're $100 trillion, we've got 97 trillion of wealth to create. that ain't just coming from the banking system. It's not big enough. It'll come from the wholesale adoption of everything using blockchain rails, digital ID, everything. So we have, when I look at the chart of interest payments and look at total liquidity, interest payments lead, and then we have to have liquidity to essentially pay for the interest payments. And that tells us we need to create about $7 or $8 trillion of liquidity in the next 12 months to pay the interest on the debts. So, okay. So that means we've got all this to go. So how does that come? Well, if we look at the changes to the SLR, this little innocuous 3-letter acronym, that probably brings 3, 4 to 5 trillion of liquidity that's driven through the banking system. Call it 3 trillion, call it 3 trillion for easy math. Then we've got the fiscal stimulus. Well, the fiscal stimulus probably adds $1.5 trillion into the banking system. So we're at 4.5 trillion. And we've barely started looking at what other levers that they can use. We've got the balance sheet rebuilding. They've got the drawdown of the TGA. Well, let's chuck in another trillion there. We're going to have 5.5 trillion. Okay, we're getting very close to the numbers. Now imagine if they then change the SLR fully and get rid of all the risk weighting. We're now immediately at 8 trillion. So without having to do any complicated maths, it's like
lowering rates.
Yeah, without even talking about rates. So the liquidity coming is big. Will it come exactly as I say? No. Will it all be smooth? For sure not. But generally speaking, that's the game we have to play. So that's what I look forward to in 2026 is like, if 90% of Bitcoin's price action is explained by global liquidity, then that's the most dominant macro factor of all time because it's 97.5% for the NASDAQ and, equivalent amongst all the asset classes. So therefore, we just need to worry about this one factor because everything else is noise. And this one factor says you need to print money. So let's talk about the performance. So right now, I've always said, expect a 35% pullback in Bitcoin twice a year in a bull market. We've had 2 of those.
Yeah.
And then what happens is there's a risk curve. So ETH falls 40%, 45%. Solana falls 60%. SUI falls 74%. Right? So there's your risk curve. On the way up, the opposite plays out. Now, it doesn't mean memes will go up, but generally, if you're in the right part of that risk curve without being too risky, you should get decent pickup from things that are less liquid and smaller, earlier phase, stuff like that.